Hi, I'm Sandhya Hegde. I run Khosla Impact, which is an early stage equity fund that focuses on tech startups that help improve the standard of living at the bottom of the socioeconomic pyramid around the globe. We particularly invest in India, East Africa, and West Africa. We look for startups that can reach millions of people over time and invest in companies that are making core services in healthcare, education, energy more affordable, or are creating a larger number of digital jobs and improving the inequity in the global standard of living. A few ways that we are different are, we are very focused on tech startups. We are very focused on emerging markets, which is India, East and West Africa. And we do only early stage equity, so we take a lot of risk on the teams that we invest in. We have a large network of philanthropic organizations, grant-making organizations, debt investors, who we kind of bring along and help grow the ecosystem for the company that we invest in. That's a great question. For us, I think technology represents a scalable tool. More than anything else, it's a tool that can amplify the impact of whatever the product or the solution is. So when we say tech, what we mean is a technology-enabled platform that is solving core problems in healthcare, in energy, in education. So for example, we recently invested in a company that uses mobile technology to help small business owners connect with their clients, get orders, deliver those orders, get payments. And the technology itself is important because it reflects a scalable solution that can reach millions of people in a short duration of time. As opposed to traditional industries where you build a lot of infrastructure but find it harder to scale quickly. So for example, a company that we would not invest in would be, say, a housing project, which is still really important, and there are several infrastructure private equity funds that would invest in that, but we would focus more on scalable tech. Yeah, absolutely. So some of our favorite companies are in energy. For example, Bbox is kind of like Solar City for Africa. They are setting up vertically integrated solar systems for off-grid households in Kenya, Uganda, Rwanda, and even as far as the Congo. They have completely remotely monitored systems and mobile money payment platforms that allow them to collect digital data and have reached over 60,000 households in very remote parts of Africa already. We also have a lot of really fast-growing investments in financial inclusion. So we have companies like NeoGrowth and Branch that are using digital data from phones, from card transactions to lend on demand to small business owners and consumers. So there are two kinds of technology innovation. You have what we call R&D. So, you have bioengineering, biotechnology, working on finding new types of vaccines or creating new kinds of materials that will really transform the entire world. And then you have what we call product innovation, where you are taking advantage of data that is being surfaced that's new. So for example, let's take a very simple problem, like lack of credit history. Most people in this world don't have credit history, and that allows and that stops them from being able to get loans to grow a business or to finance an asset that they need. One simple way technology can address that is to use the history that's already on their mobile phones. Your mobile phones have SMS updates from your bank. If you have a bank account, they have SMS histories of the payments you have made to your mobile phone company. They have your call logs, which indicate that you are a part of a trusted network of several institutions and individuals, and you can use all that to start creating credit history for people who are either not living in a country that has a formal credit bureau, or just haven't taken a loan from a bank yet and hence have zero history. So there's lots of product innovation that can kind of solve what we call inefficiencies, right? So the lack of data is an inefficiency. There are a lot of middlemen. So take agri supply chains. There are 4 or 5 different layers of middlemen between a farmer and, say, a restaurant that serves food using the produce that the farmer makes. And it's easier for the restaurants or the end consumers to work with these middlemen because they can't access farmers in a scalable, trusted way. So if you could create a platform, as some of the companies we are looking to invest in are doing, to connect these two parties digitally, then you decrease the number of middlemen required from 5 to 1. And because more and more people now have mobile phones, there are more than 4 billion phones in the world, right? So that's the one thing that has really transcended the boundaries of nations and socioeconomic classes, and has become a tool that you can reliably assume most people have. And so if you can build a product that takes advantage of that and builds on top of it, odds are that you will be able to connect these two together directly, and actually be able to eliminate inefficiencies in a supply chain. So that's, and similarly in healthcare, there's a lot of data inefficiency. There are so many different models around sensors, around cheap diagnostic monitors that can plug into your phones and transmit data that can help get access to healthcare to a broader base of people. So one of the challenges we have seen in emerging markets is that when you have a monopoly, the incentive for that monopoly to invest in long-term growth is very low. So, take successes in the world, right? Like M-Pesa in Kenya. There are a lot of reasons why, because structures like that are monopolies, at a certain point they stop investing in growth. They keep the pricing of their product pretty high, and they often stop going to the remote corners of the community because the infrastructure investment required is pretty high, and the company is already doing so well where they are that they don't need to invest. I think one of the most famous examples of this in our community is probably Western Union. The massive international remittance market that Western Union dominates makes sure that they can keep their margins really high and charge anywhere up to 7% of a transaction when somebody remits capital from, say, the US to Philippines. There are several companies that are trying to break that, right? We see everything from people trying to use Bitcoin as an infrastructure to kind of create a competing entity that has its own layers of infrastructure and has no overlap with what Western Union relies on, so that they can build something that's more efficient, more immediate, and also can charge less to win business away from Western Union. So competition is always great for the customer. So we look for the businesses that can actually challenge large, lazy monopolies and push them to also compete for markets. When we talk about kind of traditional resource allocation, a lot of it is around the financial markets, right? So if you look at what has happened in the US for clean tech, initially it took a long time for investors to see clean tech as a commercial investment. You needed a lot of tax equity funding, concessionary capital, but then there were a few startups in the market that delivered on their promises so reliably that they broke that mold of, this is a green investment that needs concessionary capital, and became landmark successes that all commercial capital investors wanted to be a part of.